imagine running a business, right? Like you are generating $1 million in revenue. You're just crushing it.
Oh, yeah. The absolute dream.
Right. You've got employees, a fleet of vehicles, money is just flowing in every single day. But then you walk into a traditional bank, you sit down across from a loan officer, and you ask for a standard mortgage to buy a house.
And we all know exactly how this goes.
We do. That underwriter punches your numbers into their system, looks back across the desk at you, and essentially says, well, sorry, according to our paperwork, you're totally broke.
It's brutal. It really is.
It's wild. Well, welcome to the Deep Dive. Today, we are exploring the financial underground of real estate. We've got a stack of insights originating from a specialized real estate lending firm out in San Diego. And our mission today is to figure out exactly how self-employed entrepreneurs are completely bypassing the massive, rigid red tape of traditional megabanks.
Yeah, they're playing a totally different game.
Exactly. We are going to look at how they aggressively scale their real estate portfolios, specifically by balancing short-term asset-based loans with, long-term rental strategies.
Right, which is the key to all of this.
It is. So, okay, let's unpack this. Because this fundamental paradox faced by the self-employed investor just feels entirely broken. I mean, how can someone be cash rich but paper poor to a bank?
Well, it feels broken because the traditional banking system was fundamentally designed for an economy that honestly doesn't really exist in the same way anymore.
Yeah, that makes sense.
Right. Like the mega banks, we all know, they are built almost entirely around the predictability of W-2 income. They want a salaried employee with this steady, unchanging paycheck that hits an account every 2 weeks, like clockwork.
Right, no surprises.
Exactly, no surprises. The algorithms underwriting those traditional loans, they just do not know how to process the dynamic, fluctuating reality of modern entrepreneurship. It's just a profound disconnect.
But it's worse than just not understanding the fluctuations.
Right.
Because a smart entrepreneur is actively trying to reduce their taxable income.
Oh, exactly. And that is the exact friction point here. I mean, if you own a business, your CPA is going to tell you to legally write off your expenses.
You'd be crazy not to.
Right. You reinvest your profits back into the company. You take deductions for your home office, your mileage, your equipment.
Yeah.
You are doing exactly what the tax code incentivizes you to do, which is to optimize your business and minimize your tax burden.
But then you take those beautifully optimized tax returns and you hand them to a conventional mortgage underwriter.
And they take you completely literally.
Oh, wow.
Yeah. The underwriter doesn't look at the $1 million in gross revenue. They look at the bottom line of your tax return, which, might say your net personal income was only $60,000 after all those deductions.
Right.
Right. Then they apply their super strict debt-to-income ratio to that artificially low number, and suddenly you don't qualify for the loan. You are effectively penalized for running your business correctly.
So if you're a business owner listening to this right now and you've hit that exact brick wall, how do you actually get out of that trap? Because obviously self-employed people are still buying real estate.
Oh, absolutely. They are completely bypassing the W-2 underwriting process using alternative lending mechanics.
Okay.
The first major tool here, and the sources emphasize this heavily, is the bank statement loan.
A bank statement loan.
Yeah. So instead of handing an underwriter 3 years of highly complex tax returns that basically hide your actual liquidity, you hand them 12 to 24 months of your business bank statements.
Wait, literally just like the PDFs of my Chase or Wells Fargo checking account?
Precisely. Just the statements. Because what the alternative lender is doing, they're looking at the actual velocity of your cash.
Velocity, I like that.
Yeah, they look at the deposits hitting your account month over month. They calculate your real breathing cash flow, average it out, and they use that actual number to determine your purchasing power.
Wow, so it is a total shift in underwriting philosophy.
100%. What's fascinating here is they are looking at the liquidity you actually have access to right now, today, rather than some backward-looking tax document that was strictly designed for the IRS.
That makes so much more sense. Like you're finally getting credit for the actual money moving through your life.
Exactly.
But I know that's really just the tip of the iceberg, right? Because from the sources, the really aggressive investors aren't just using their own bank statements. They are using something called hard money.
Ah, yes, hard money.
And honestly, the term hard money always sounds to me like something involving a guy named Vinny and a baseball bat. Like, what actually is a hard money loan?
Yeah, it definitely has a gritty name, but it's a completely legitimate, incredibly powerful financial tool. What's fascinating here is that hard money takes the whole concept of alternative lending and just pushes it to the absolute extreme.
How so?
Well, with a bank statement loan, the lender is still looking at you, right? Like you as the borrower, your personal cash flow.
Right.
With a hard money loan, the lender barely looks at you at all. They shift the qualification burden almost entirely onto the asset itself.
Great. How does a lender loan money to an asset? Like, they still need a human being to pay them back.
What they do, of course. But their real security is the property, specifically its after repair value, or ARV.
ARV, got it.
Let's actually look at the market dynamics in San Diego County as our blueprint here, like the sources did.
Yeah, let's do an example.
Okay, say you find this dilapidated, deeply distressed house in El Cajon. It's an absolute mess.
Okay, I'm picturing it.
The roof is leaking, the kitchen was gutted by the previous owner, and it just smells terrible. But you can buy it for $400,000.
$400K. Okay.
But, as an investor, if you put $100,000 into a massive renovation, that house will be worth $700,000 on the open market.
Okay, I follow the math. Buy for 4, fix for 1, it's worth 7.
Right.
So there's 200 grand in equity there.
Exactly. Now, a traditional bank won't even touch that deal. We'll get into why in a second. But a hard money lender, they look at your business plan, they agree that the after repair value is $700,000, and they base their loan on that future number.
Oh, wow. Based on the future value.
Right. They lend you the money to buy the property, and they lend you the money to fix it, all secured by the immense equity you are creating through the renovation.
Okay, I have to stop you there. Because I was looking at the actual mechanics of these hard money loans in our research, and the terms are wild.
They are intense, yes.
The interest rates are significantly higher than conventional mortgages, right? Like sometimes double.
Oh, yeah, double digits easily.
And worse, they come with a ticking clock. The repayment terms are usually incredibly short, spanning just, 6 months to maybe 2 years. Why would any savvy investor willingly walk into a financial trap that tight? I mean, you're taking on highly expensive debt that you have to pay back almost immediately.
It's a really vital question because, on paper, it sounds like financial suicide.
It really does.
But the answer is entirely driven by the reality of the market. In highly competitive arenas, whether you're looking at coastal properties in Pacific Beach or inland out in El Cajon time, literally kills deals.
Right.
If you find an undervalued off-market property, you are not the only investor looking at it.
You're competing with massive institutional buyers and, local guys carrying literal briefcases of cash.
Exactly. Now, consider the timeline of a traditional mega bank mortgage. Best case scenario, everything goes perfectly. It takes 45 days to close.
45 days is a long time in real estate.
It's an eternity. But during those 45 days, the bank isn't just scrutinizing your tax returns. They are intensely scrutinizing the property. Conventional lenders have very strict habitability standards.
Right. The house has to be livable for them to actually give you a standard 30-year mortgage.
Yes. So, going back to our El Cajon example, it has a gutted kitchen and a leaky roof. 30 days into your 45-day traditional loan process, the bank's appraiser goes out there, sees the missing kitchen, spots a bad termite report, and what happens? The bank immediately pulls the funding.
Oh, man.
Yeah, they will not lend on a distressed asset. The deal is dead.
That is just infuriating because you find a property that's cheap exactly because it needs new kitchen. That is the entire mechanism of the investment. You are going to add value.
Exactly.
But the bank won't let you buy it because it needs the value added. It's a complete catch-22.
Which is exactly why you pay the premium for hard money. Alternative lenders are fast, and they don't care about habitability because the whole point of the loan is the renovation.
Right, they know it's a project.
Exactly. A bank statement loan can close in 14 days. A hard money loan. They can fund a project in 5 to 10 days. And in incredibly competitive situations, specialized private capital can sometimes provide funding in as little as 48 hours.
48 hours? Wait, really?
Yep, 48 hours.
Okay, here's where it gets really interesting to me because suddenly that 12% interest rate makes total sense.
It does.
It is leverage. It's like buying an express pass at a crowded amusement park, but taking it a step further. You aren't just bypassing the 45-day wait in line. You are using that express pass to walk right to the front, secure the seat on the roller coaster, and lock everyone else out before they even get their tickets punched.
That's a perfect way to look at it.
Yes, the hard money costs more up front. but it allows you, as an independent self-employed investor, to compete head-to-head with all-cash buyers. You secure the distressed asset, fix the kitchen yourself, and take control of the deal.
You are explicitly paying for the agility to win the contract.
Exactly.
This raises an important question, though, regarding risk mitigation. The Express Pass is powerful, but as you pointed out, it is a strictly short-term tool.
You can't hold on to it forever.
No, you cannot sit on a hard money loan for 5 years. The clock is ticking loudly. If you don't execute your renovation on time, or worse, if you miscalculate the after-repair value, that high interest rate will absolutely consume your profit margins and eventually your underlying capital.
Which is why you really can't be an amateur guessing at what a kitchen renovation will do to a property's value.
Precisely. And it's why leaning on local lending expertise is absolutely vital. A local lending institution in San Diego understands the hyper-specific block-by-block market dynamics of a neighborhood like North Park versus Chula Vista.
Right, they know the dirt.
Yeah, whereas a national mega bank underwriter sitting in a cubicle 3 states away simply doesn't have that granular data. If your entire strategy relies on the property being worth $700,000 in 6 months, that valuation must be dead accurate.
Okay, so let's walk through the exact timeline here. You've used the hard money Express Pass. You beat the cash buyers, you acquired the distressed El Cajon property, and over the last 4 months, you put in the new kitchen, fixed the roof, cleared the termite damage.
Perfect.
The house is beautiful now, but you still have this massive, high-interest, hard money loan hanging over your head, and it's due in a few months. If you can't build a sustainable empire on short-term debt, how do you actually survive this phase?
This is where you transition into the second phase of the strategy. You don't hold the hard money forever. You use it to force the appreciation and then you exit.
Okay.
This brings us to the core engine of real estate portfolio growth. It's called the BRRRR method. BRRRR.
The RRR stands for buy, rehab, rent, refinance, repeat, right?
You got it.
Okay, so we bought it with hard money and we've rehabbed it. What's next?
You rent it. You place a high-quality tenant in that newly renovated El Cajon house. Suddenly, the property is generating monthly income. Now comes the critical move, the refinance. You go back to your alternative lender and you refinance out of that expensive, short-term, hard money loan, paying it off entirely.
Okay, that's a relief.
Exactly. And in its place, you take out a long-term specialized rental loan called a DSCR loan.
DSCR, debt service coverage ratio. Listeners, we have to pause here, because if you are self-employed, understanding DSCR loans feels like finding a cheat code to the financial matrix.
Oh, it really does.
Explain the mechanics of this, because it completely blew my mind when I read it.
It is the ultimate tool for the entrepreneur. Remember how the traditional bank capped out your debt-to-income ratio based on your tax returns earlier?
Yeah, because my business write-offs made me look broke.
Right. Even if you manage to somehow get one standard mortgage, if you go back to that mega bank and ask for a second or third mortgage for rental properties, they will laugh you right out of the building.
Definitely.
They view every new property mortgage as a massive personal liability against your relatively small paper income.
Right, they say, well, you only net $60,000 a year. How can you possibly afford 3 mortgages?
Exactly. But a DSCR loan, it completely ignores your personal income.
Completely.
Completely. The debt service coverage ratio compares the property's gross rental income directly against its own debt obligations. That is the entire underwriting formula.
So my income doesn't even factor in?
No. Let's do the math on the El Cajon house. Let's say your new long-term DSCR mortgage payment, including taxes and insurance, is going to be $3,000 a month.
Okay.
If the tenant you just placed in that house is paying $3,600 a month in rent, the property pays for itself.
The ratio is positive, the income covers the debt service.
Exactly. The lender usually wants to see a ratio of 1.0, meaning breaking even, or maybe 1.2 or 1.25, meaning the rent comfortably exceeds the mortgage.
Wow.
If the math on the property clears that hurdle, you get the loan. Your personal W-2s, your tax returns, your minimized salary history, they are not even submitted to the underwriter.
It's like the property becomes its own standalone business. Like the house itself is the employee, and it is earning a wage, which is the monthly rent, to pay its own bills.
That's a great analogy.
Your personal finances are completely detached from the asset's ability to sustain itself.
Yep. And if we connect this to the bigger picture, you can see how this creates an almost infinite loop of scalability.
The repeat phase.
That's right. Step 1. You use the quick, agile, hard money to aggressively acquire a property and force appreciation through rehabilitation. You create massive equity out of thin air by fixing the problems traditional banks hate. Step 2, you use the DSCR loan to lock in long-term 30-year stability based entirely on the asset's self-sustaining cash flow. Because the DSCR loan doesn't rely on your personal debt-to-income ratio, there is no arbitrary limit. You can execute this BRRRR method over and over and over again.
You are entirely untethered from the limitations of conventional banking. Which, yeah, brings us right back to the repeat part of the acronym. You just keep doing it. You're combining the incredible aggressive speed of private hard money with the endurance and passive income of long-term rental cash flow.
It's a very powerful balance.
It is brilliant. But that naturally leads to the next question from the sources. If you are a self-employed investor and you've mastered this two-step dance, what are you actually buying? If you start with single-family homes in Chula Vista or El Cajon, what is the ceiling?
Well, the evolutionary path from investor who masters the strategy almost always leads to the same destination, which is larger multifamily assets.
Multifamily, okay.
We are talking about scaling up to duplexes, fourplexes, or even 10-unit apartment buildings in high-demand, stable areas like North Park.
And, I mean, the leap from a single-family home to a 10-unit apartment building feels massive. But looking at the sources, the underlying financial logic is incredibly compelling. It really comes down to economies of scale, right?
It is entirely about logistics and risk mitigation. Just think about the operational nightmare of owning 10 separate single-family homes scattered all across San Diego County.
Oh, driving all over the place.
Exactly. You are dealing with 10 different roofs that can leak, 10 different foundations that can crack, 10 different landscaping bills, and a massive, exhausting geographical footprint for your property management team to cover.
Sounds like a full-time job just managing the managers.
It is, but a multifamily property consolidates all of that chaos. You have 10 streams of monthly rental income flowing from one centralized location, one roof, one property manager, one centralized insurance policy.
But the part that really clicked for me when looking at the mechanics of scaling was the concept of vacancy risk.
Oh, yes. The vacancy risk is huge.
Because, on the surface, taking out a massive DSCR loan for a multi-million-dollar apartment building sounds absolutely terrifying. But it's actually safer than the single-family home, purely because of the math.
It really is just a numbers game. Let's look at the worst-case scenario. If you own a single-family rental home and your tenant loses their job and moves out, your vacancy rate for that specific asset instantly goes to 100%.
Boom. The income drops to zero.
Right. And suddenly, that standalone business isn't paying its own bills anymore. You, the investor, have to reach into your own pocket to pay that monthly mortgage until you find a new renter.
That can drain your personal liquidity super fast.
Exactly. It's an incredibly stressful vulnerability. But if you've scaled up, and you use these specialized commercial loans to acquire a 10-unit apartment building, what happens when one tenant moves out?
Well, you still have 9 people paying rent.
Precisely. Your vacancy rate is only 10%. Those 9 remaining income streams are still easily covering the entire DSCR loan debt for the building.
That's incredible.
Yeah, the property remains perfectly cash flow positive while you take your time, you paint the empty unit, and you find a high-quality replacement tenant. The single biggest threat to a real estate investor, which is vacancy, is completely diluted.
Wow. Diluted risk, centralized management, and compounded cash flow. That is the ultimate destination for the BRRRR method.
So what does this all mean? When we zoom out and look at all these complex pieces together, the bank statement loans that bypass the tax return trap, the hard money and bridge loans that act as an express pass to beat cash buyers, the DSCR financing that treats properties like self-funding businesses, and that ultimate shift into multifamily assets, they were essentially building blocks.
Absolutely.
They are specialized tools that allow out-of-state investors, local developers, and everyday self-employed entrepreneurs to completely ignore the traditional W-2 gatekeepers. You are no longer asking a mega bank for permission to grow based on a distorted tax return.
You're calling your own shots.
Exactly. You are leveraging the intrinsic value, the physical improvements, and the actual cash flow of the real estate itself.
Yeah.
So just to quickly recap this journey, we started with the infuriating paradox of the self-employed penalty. We saw how you can escape it by proving your true liquidity with bank deposits.
We explored why savvy investors willingly take on double-digit interest rates for the sheer speed of hard money, allowing them to secure distressed assets, before traditional banks even finish their paperwork. And finally, we broke down how to build actual generational wealth by refinancing those quick acquisitions into long-term DSCR loans, ultimately scaling into multifamily properties to really bulletproof your portfolio against vacancy.
It's a really elegant system when you put it all together.
It really is. And if you are listening to this right now, whether you're a seasoned investor looking for more leverage, a business owner who is just frustrated by your local bank, or just a deeply curious person trying to understand how modern wealth is actually built, understanding this agile, asset-based side of finance completely changes your perspective.
It changes everything.
The next time you drive down the street and look at a newly renovated apartment building, you'll realize the game isn't about how much the owner's W-2 says they make. It's entirely about the math of the asset itself.
And, that realization leaves us with a really fascinating dynamic moving forward. We are watching a real-time evolution in how capital is deployed.
How so?
Well, if these alternative asset-based lending models are proving so incredibly successful at identifying true profitability and sustainable cash flow, how long until the traditional megabanks realize they are losing massive market share?
Oh, wow. Okay.
Right. Will they be forced to abandon their outdated W-2 underwriting models just to stay relevant in a gig economy world? Or are we looking at a future where the real estate market is permanently split into one slow, rigid system for the traditional employee and a light and fast, agile financial ecosystem for the entrepreneur?
It really makes you wonder who's actually holding the risk in the long run. Thank you so much for joining us on this deep dive. Go look at some real estate, and we'll catch you next time.